Hello, I'm Mario Cordero, Chief Executive Officer for the Port of Long Beach. Welcome to another Port Update. My guest today is Paul Bingham, Director, Transportation Consulting for the information analytic firm S&P Global Market Intelligence. Paul has more than 30 years experience in global transportation and trade economics, consulting, working with port authorities and their customers worldwide. Paul provides analysis and forecasting regarding market demand, international trade, and supply chain risk. He is a frequent speaker at port industry meetings and frequently sought by news media for his experience in freight transportation and developing economic forecasts with a maritime trade perspective. Paul is a member of the U.S. Maritime Board of the National Academy of Sciences, former member of the U.S. Federal Advisory Committee on Supply Chain Competitiveness, and former chair of the U.S. National Academies of Sciences Transportation Research Board Freight Systems Group. Paul, welcome.
Thank you, Mario. Great to be here today.
And I'm very excited for you being here and joining us, given that the topic of the day, or at least for the last several weeks, is tariffs and trade policy. So with that, as you know, the White House is approaching trade policy to address what may be legitimate concerns, but certainly there's a great deal of uncertainty in this industry. So from your perspective, in all the many years of experience that you had, is this an unprecedented time with regard to the level of uncertainty?
Yeah, absolutely. There's nothing like this that any of us that are still active in our careers have seen before. From an economics perspective, we'd have to go back over 90 years to the 1930s to find tariff levels for the United States on a trade-weighted basis close to what they are right now. And as far as disruption goes, the only thing close to it that any of us have lived through really was the early days of the pandemic in 2020, when we had tremendous uncertainty about what was ahead in the near term. But even this is very different than that. The uncertainty here is not something because we have a virus we don't understand. It's the uncertainty around policy and what that has done to business, where there's lack of certainty, lack of ability to plan, has imposed costs on all of us. And it's really something that's making it very difficult for anybody that has planning as their responsibility to make decisions for their organizations, whether they're in a supply chain or whether they're in a business only indirectly affected by trade.
It's interesting you mentioned COVID. In a recent interview or question by a journalist here, I referenced the fact that we're in a COVID moment. And it was in regard to the cargo flow or lack of, or what that forecast is. So from your perspective, what tools do you look to in terms of now trying to attempt to have an accurate picture of what that looks like in terms of our economy, as you discuss with your customers and clients?
Well, we start with monitoring the trade policy announcements, which, as you know, is sort of every day that can change, trying to understand what commodities, what countries, what the timing, what's the level, understand what does a decision maker actually have to take into account if they're trying to calculate what does that tariff cost mean to them. If they're trying to negotiate with their suppliers and push back on the tariff costs, or they're trying to understand if the tariffs get reduced, what does that mean for them, and reduced by how much, and the timing, trying to sync that up with their own inventory management, their own sales planning. It's making it more difficult to be able to understand what signals to follow. However, we have good trade data. Port community information systems, such as you have here at the Port of Long Beach, allow you to look ahead a little bit when you see those vessels from when they start to sail from the foreign port, or they don't because that voyage has been blanked, to understand what's coming in the very near term. We also look at indicators at monthly export statistics. Export statistics are leading ahead of the import side, obviously, because it's when those goods leave a country, not when they've actually been landed. Gives us a little bit of a heads up. And we use in our company our own, what we call our supply chain console, which is an integration benchmark of a number of data sources that monitor trade and also monitor vessel activity to understand what might actually be happening in a particular supply chain in terms of either the drop off in volumes or a spike up in volumes in return.
So one of the things that's been much written about is the Wall Street, the reaction on Wall Street, and the ups and downs. But if you could comment a little bit about another metric that sometimes the public is not aware of, is following the bond market. Can you comment on that on a general overview of why that's important?
Well, the bond market is a measure of ultimately the cost of debt, the cost of capital. That extends, most commonly you think of as U.S. Treasuries represents the bond market. There's actually the full spread of municipal bonds of government agencies at every level. Internationally, there's bonds, and then there's corporate bonds that reflect the cost of capital. That T-bill rate, or the rate that the government is having to pay for their debt, it's an interest rate indicator, is an indication sometimes of reactions and expectations around inflation. But it's also a measure of perceived risk around a particular debt holding, and that goes along with the potential for whatever the issuer of that debt is to manage that debt, and that includes up to the level of the U.S. government. So we've seen right now some bond market reactions towards what they perceive to be the safety and security of U.S. government debt. And we just had one of the ratings agencies reduce their rating on U.S. government debt. That has implications. Typically, a lower rating usually follows with a higher interest rate that you have to pay. That also is oftentimes correlated with inflation, expectations for inflation and expectations for interest rates that will accompany that from the central bank, like the Federal Reserve Board in the U.S. So it becomes a very shorthand but very effective indicator of what would be an important factor affecting economic decision making, which is that interest rate or cost of capital, or inflation, which affects everybody's purchasing decisions, and it affects the investment decisions, and it affects the potential of the economy to achieve its potential.
Well, despite the risks that are certainly of great concern, you reference exports, and part of this tariff policy or discussion really commenced with addressing two things. One, whether we could accelerate or increase manufacturing in the USA. Two, address the imbalance between imports and exports. Mm-hmm. Now, history tells you that's very difficult to accomplish based on a tariff policy. But there's a third aspect to it that we're seeing is as a negotiating tool. Mm-hmm. So, trying to see light at the end of the tunnel here. I mean, the good news is there's been a pause on April 8th. There was a pause on reciprocal tariffs, mm-hmm. which ends on July 8th. And who knows what happens after that. Mm-hmm. But, all eyes are on the discussions between USA and China. So there's been a pause on that with regard to, obviously, 145% now is down to 30, and mm-hmm. China, in turn, 10 on exports, 10%. Mm-hmm. So what is your view in terms of ultimately, how does this move the needle with regard to U.S. manufacturing and increasing U.S. exports?
Well, first off, to address the manufacturing question, if we put up a tariff wall, if we raise tariffs on imported commodities, then the domestic producers we have for those commodities have lower competition, obviously, from import prices being higher. Oftentimes that allows them confidence to expand or to at least maintain production. Sometimes they also may raise their prices, and we've seen that in some specific commodity categories already, such as with the tariffs on imported iron and steel and aluminum. It also, though very importantly, has only the impact in terms of pricing immediately. Tariffs can obviously change very quickly. If a company is going to invest in manufacturing capacity, especially for more complicated goods that require tiered supply chains, that may take a much longer time to be able to establish and get up and running if we're trying to expand manufacturing capacity, not just make use of latent capacity that we already have in place. And it's that kind of restoration of manufacturing in the United States which faces a much higher barrier. It's much harder for companies to commit the capital and resources to build the plant and equipment, to train and recruit and find the workforce that's going to work in those factories, and perhaps build a supply chain of domestic suppliers of the inputs you would need to be able to run those manufacturing facilities. And that can't happen in a week, can't happen in a month. It takes much longer than that to build manufacturing capacity. And because of the ability of tariffs to come and go, really companies are going to look for certainty. They want some assurance that those tariffs, if they're going to depend on the protection of tariffs to allow them to be competitive in manufacturing in the United States, they want some assurance that those tariffs are going to be maintained and still be there. And that gets to your second point about tariffs being used as a negotiating tool. Well, if in fact they are being used as a negotiating tool, obviously that can prove very powerful in just as we've heard the administration say, by controlling effectively the pricing away the access to the big U.S. market. But it also means that perhaps those tariffs go away, but maybe they achieve some other end goals that we would like to achieve. And an example of that in relation to U.S. export competitiveness is maybe we can convince some foreign trade partner countries to the United States to open their markets to U.S. exports more than they have been in the past, to reduce their tariffs. The administration has been very clear that they've pointed out clear examples where U.S. exports face substantial tariffs in certain foreign markets. And if the negotiation, if there's some deal that's actually be able to negotiate it bilaterally, perhaps we would see at the end game of this having access to markets for U.S. exporters that previously had been essentially closed off or made much more difficult by the rate of tariffs that they faced. And from an optimistic perspective, perhaps that's the most beneficial end goal in this, is that at the very far end of this, you'd have negotiated trade relationships that make markets be more open to U.S. exporters and, in fact, achieve some of what can be described as that fairness of trade in both directions.
So for the average American out there, we're all anticipating what the end deal is going to be. So one of the things that you mentioned, normalcy, so to speak, certainty, clarity. In talking to our customers in the trade world, in the import-export world, I think the common denominator response by people in the business sector, set aside what your view is on trade policy, is all they're asking for is permanency, clarity, and assurance that there's a policy going forward that they could, have their business planning and in the future here. So with that, again, for the average person here in the USA, can you basically indicate what does normalcy look like? In other words, at what point do we say, okay, we're going back to some normalization of trade policy and cargo movement? What are you going to look to?
Well, I think at this point, we wouldn't define normalization as, say, some sort of, from 20 years ago perspective on what the U.S. was assuming could be a global free trade world. We're probably likely to still have regional trading blocks that persist for a very long time, such as exists today, essentially closing off trade with countries like North Korea and Russia and other countries that have been sanctioned by the United States, with whom we essentially are not trading. But for the majority of the world, achieve a normalcy where we have stability. And we really saw that, if you think about it, coming back out of the first Trump administration, and then what President Biden had also done to sustain a lot of those tariffs. We survived as an economy and learned to adapt and adjust to tariffs at a higher level on certain products with certain countries. And that you could describe as a new level of stability, even if the average tariff rate that we were paying was higher than had been, prior to that for a very long period of time. And I think normalcy in the future may be something as an echo of that, where we would achieve stability perhaps at a higher tariff rate, perhaps we're somewhat close to this worldwide U.S. 10% import tariff. But if that was in place with certainty, and supply chain managers and investors could rely on that being the new normal, that what they would expect to pay, then they can put that into their financial models, and they can put it into their contracts with their customers and their suppliers, and they can plan around dealing with what the repercussions of that are. And that's really where you can get to normalcy, if we can have stability and understand that for a longer period of time, we can rely on relative stability in those relationships and the costs and the prices that we would face. And then we can adjust the supply chains and the manufacturing and even the proportion of trade that we engage in, as opposed to having onshoring or nearshoring. That can be made in a context where you can make decisions with certainty, unlike today where it's nearly impossible.
Well, it's interesting, Paul, I tend to have what I've termed rational optimism that this will play out and things will be fine. I think people have to realize we've been living in a tariff environment for some years.
That's
the
right.
Biden administration didn't pull any of this back.
That's right.
So, and nevertheless, we've had a great economy. And you may know that at least for the San Pedro Bay complex, which consists of Port of LA and Port of Long Beach, together in 2024, we moved a record number of container volume in excess of 20 million. And now in 2025, the latest hard data that we've received are the April numbers. So we continue to be, in 2025, the #1 port of Long Beach, for 4 months now, and 11 months of very positive numbers. Now, I say that only in regard that while things have been difficult, it's not catastrophic. So we're trying to have some optimism here that, again, this will work out in time. So on that point, the San Pedro Bay complex is always in the eyes of the nation. Going back to COVID, as you know,
Yes.
The White House directed an envoy to address the issues that we were having at that time in a tumultuous scenario, which we had the health pandemic of the century. And very much similar to only in these times in terms of uncertainty. So what is your view now of what your forecast is of the San Pedro Bay complex for year 2025?
Well, for the port complex as a whole, between Port of Long Beach and Port of LA, together, still being the #1 gateway, and in fact likely to still grow this year when we look at it at annual frequency, but probably a little bit front-loaded into the first half of the year. The ports have done very well at the very beginning of the year, partly as a result of companies trying to move ahead some inventory in advance of the uncertainty around tariffs. Not perhaps as much as some people have speculated, but there's clear signs that there has been some advancement of inventories, and you've heard some companies being very specific about that they have engaged in that on purpose. That means some of that volume that the ports have already handled is a pull ahead from later in the year. We may not have the peak, say, at the level that we had it in 2024 for San Pedro Bay, but it's possible that if many deals are made and you have stability in the trading relationships later on in the second half of the year, that volumes would actually be higher than our baseline forecast is right now. Right now, we have a forecast where the volume of trade slows, still growing, but growing very slowly compared to last year through the port complex. And that is likely a reflection both of the underlying demand. We are not, our baseline forecast for the economy as a whole is we are not going into recession. Despite the disruptions that we've seen already, there is still sufficient strength within the economy in terms of employment, in terms of consumer confidence, even though some metrics of those have fallen. But there's also downside risks, and we qualify our baseline forecast with scenario alternatives, and those include downside risks that are greater than the upside risks. So there is a potential that the disruptions from tariffs and some of the other factors in the economy that reflect uncertainty could lead us into a recession and a fall in demand. And we saw that in the beginning of the pandemic in 2020, where you had that first very short but sharp drop in demand through the ports in 2020. We wouldn't forecast something that would be an echo of that completely, but you could be in a period where the second half of the year sees lower volumes than were handled in the first half of the year, very unusually. As far as congestion fears go of the pandemic, there's none there. You've handled record volumes last year. You've set a record and did it with essentially no congestion. Nobody in the supply chain was focusing in on the port complex saying they can't handle it. And even with the likely surge that's coming right now, hasn't gotten here yet, out of the mainland China deal and their 90-day pause, it's unlikely that the ports, starting from where you are right now in terms of performance, would run into a problem of performance such that that would impede volumes, would divert them somewhere else, for example. That seems extremely unlikely. In fact, the way those 90-day pauses are working, in some ways, they're accelerating some market share gains for the ports, because if shippers are trying to concentrate and pull in as much cargo ahead of a particular deadline, then it's that shortest route, the Trans-Pacific first call into San Pedro Bay is where you're going to go first. So that actually sustains some of that market share gain, perhaps, that the port complex captured last year into 2025.
Well, that certainly furthers or affirms our sense of rational optimism. But you mentioned surge. So I think right now, in terms of this sector here, there's different views with regard in terms of whether or not we're going to see that. I tend to think that we are going to have a slight surge. And the reason, number one, for the reasons you just gave. But second, there's a lot of cargo that was held up in China that did not come, because if you're a shipper, why would you send your cargo to be subject to 145% tariff?
Right.
So we know that there's cargo in China that's there that did not come. And we also know that that cargo is going to start coming as we now approach peak season in July. Now, having said all that, I will say that our May numbers may not look good.
Right.
We've had a great first quarter and entered the second quarter with April with great numbers. But right now I could tell you for the average here at the Port of Long Beach, we have 20 container vessels that call on the Port of Long Beach a week. So for this week, that number is 18.
Yeah.
But if you go 2 weeks further into May, that number is 14. So June is going to be critical because we'll see what that number is. And that's a very important metric because if we go back up to 18 or even 20, that's very good. If we stay at 14, that may not look good for the second half. But the uncertainty continues. So on that question, the economic impact, you kind of, I think, touched on it. We're coming out, the Port of Long Beach, with an economic impact report. Nothing surprising. We are the economic engine for the region, the state of California. And in terms of the nation, obviously, whether it's a pandemic or whether it's a trade policy that affects imports, exports, and the GDP, everybody looks to the Port of Long Beach and the St. Peter Bay complex. So our economic impact report will show that now the direct and indirect jobs coming from Port of Long Beach are at 2.7 million. At the state level, that number is 1.1 million. So obviously what happens in San Pedro Bay or California really is a signal as to what happens in the nation. So let's talk about California overall as we look at this scenario, because obviously California is the fourth largest economy, but on the other hand, there's a lot of debate in some policies of the state of California in terms of the Washington thinking. But nevertheless, how do you see the state of California for year 2025?
Well, the state is still benefiting from its role as the trade gateway. I mean, that doesn't diminish by the fact that we've had perturbations. If you have up and down month to month in terms of the cargo flows, there's no sign of abandonment of relying on reliable transportation services through California that will continue, primarily here in Southern California. Other aspects of the economy continue to do well. Doesn't touch as much on the trade sector as much, but the tech sector has been doing very well still, and there's still an enormous boom in the AI sector. That goes back to the strengths of the state in the tech sector. The trade is not entirely divorced from that. For example, there's a rush still to build data centers to support AI processors, and those actually have to be equipped with physical equipment. Oftentimes, a lot of that is still being imported. So there's actually some trade volume tied to what people may not think of immediately when they think of artificial intelligence investments. Some of that's being driven by data center build-outs that get equipped by trade volumes that bring in the equipment to actually put the racks in and the other equipment that fills up those buildings. But that's also a measure of some of the diversification of the California economy. It's not solely a physical cargo handling marine port state. There's an enormous amount of other industry activity here, which the trade sector facilitates, but the state also relies on other sectors for its growth, including an enormous services sector, which is not diminished. In fact, the services sector has done perhaps better in the last few years after the pandemic, compared to the goods sector.
So, Paul, let me ask you one last question. Given your many, many years of experience, particularly in the trade port industry, looking back, including the present day, but looking back, what are 2 points, 2 areas in our history that you look back and say, that was a real challenge, but we got over it. We moved forward.
Actually, those are great questions. I think one of the most profound one was the mechanization, if you will. This is going back many, many decades onto the West Coast, was the mechanization agreement on the part of the longshore labor unions to allow the growth of containerization and the adoption of that technology to have container shipping replace the old, general cargo break bulk movement of cargoes back, 60 years ago. That really positioned California and San Pedro Bay to capture its current position, which it didn't hold prior to the era of containerization and the globalization that went with that. I think subsequently some of the innovative developments, for example, convincing the nation to invest in the Alameda Corridor, to develop that you can call it a trench, but really it was an elimination of grade crossings, surface level movements for rail movements to allow on-dock rail and rail movement of cargo away from the ports into the downtown rail yards, that really crystallized for the country the importance and got the national level support to say that this region played such a critical role that it would actually attract federal level investment to provide some of the debt financing to have that happen, in recognition of this region's role and importance on a sustained basis. There's many other examples we can point to that have followed on that, but I think that if I had to pick one that stands out, there's not been an equivalent singular focus on another port gateway region in the country from the whole nation that we've seen that represented.
Well, that's very interesting, Paul. In terms of the era of containerization, you're going back to 1956.
Right.
The Alameda Corridor, 2001.
Yeah.
And interesting that we're talking about the Alameda Corridor because one of for the Port of Long Beach, our endeavor of the century right now is our Pier B rail facility enhancement. It's going to be a game changer, the largest inner harbor facility of any port in the country.
Right.
But parallel to this project now, that we did not know when we gave the green light to our Pier B project, was the BNSF announcement of BIG, the Barstow International Gateway. Is it 4,700 acres of an intermodal facility, which will be the largest intermodal facility in the country. That's only 130 miles from the San Pedro Bay complex. So we're putting those two projects together. When the media asked me, what does the San Pedro Bay complex look competitive-wise at the end of the decade? We are in a great position, in my view, because of this. And going back to the Alameda Corridor, I think we're going to see a maximization of use of the corridor because of these two projects. So, yeah, I think that's going to really add to your observation that the opening of the Alameda Corridor in 2001, though many believe we should have maximized earlier in terms of these numbers, will happen. So with that, Paul, listen, I want to thank you so much.
Thank you.
For being here at Port Update at the Port of Long Beach. And I look forward to speaking with you again at the next Port Update. So stay tuned as the Port of Long Beach continues to evolve as the port complex state-of-the-art of the nation. Thank you so much.